Well, good afternoon, everyone. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. Welcome to our Mortgage Minute, coming to you every Thursday at 2 p.m. Pacific Standard Time, and from Palm Springs in the greater Coachella Valley area. Um, Today, things are cooler. Temperature here is actually under 100 degrees, so it's interesting how a week ago, Southern California was in quite the heat wave. And it seems as of about yesterday, that heat wave broke, and we've got some pretty moderate temperatures. And in addition to the low temperatures, interest rates remain on the low side. They've been pretty stable, and we are now solidly in the fives. Jeff's going to pull up, as you know, we like to show you our rate grid from our website where we provide you interest rate indications. And again, I call these indications because these rates that you see are based on certain parameters. Every borrower's specific situation may affect what you see on the screen, but again, it gives you an indication of what's available. And what you can see here is we are well into the fives now. Conforming 30-year fixed, 5 and 5/8 with a decent credit score and down payment size. In fact, interestingly, Yahoo Finance this morning said the average conforming rate was 6.2. Now, of course, that's an average. I'll give them credit for that, but there's a lot of folks who can qualify for under 6%. Look at 15-year fix. It's under 5 now for 0 points, 4 and 7/8. And then you've got FHA and VA very low in the 5.125 range. So these are excellent rates. And then if you look at those buy downs, I mean, consider a 30-year fixed conforming loan with a 3-2-1 buy down. You can get a first year rate at 2.625. Does that sound like 2020 or 2021? I think so. So if you're looking to buy a home, you should certainly talk to us about the temporary buy down option and how it can help you get the kind of rates we saw 3 and 4 years ago. So what's going on with the markets? We like to show you the 10-year bond yield chart. There it is. Jeff just pulled it up. This is a chart from last Friday to today. And you can see how the bond yield trended downward beginning of the week. And then actually hit a low point yesterday. And in fact, interestingly, since yesterday, it's actually creeped up just a bit. That hasn't affected mortgage rates that much, but so that overall, we're still in those levels that we just showed you on our rate grid. But overall, though, things are in a pretty good situation. So what I want to mention in terms of where mortgage rates are now and how the bond market has reacted, well, this week, the economic data points, not that much on the calendar, but I call it inflation week. I call it inflation week because the two key economic data points released this week were the CPI and the PPI. Starting with the CPI, that's a consumer price index. That's inflation at a retail level. That was released yesterday. And of course, the news was that it came in lower than expected. In fact, the consumer price index came in 2.5% year over year versus 2.9% in July. Now that was great news, right? Now the core CPI, excluding food and energy, a little bit different story. Year over year, 3.2%, unchanged from the month before. So a little bit of a mixed signal there. Retail CPI with not excluding food and energy, lower. But excluding food and energy, kind of flat. That was a little bit unexpected. So a little bit of a mixed message. And that's actually why you saw the bond yield creep up a little bit after the release of the CPI, not down, simply because of that core CPI number. And then today on the calendar was the PPI, the producer price index. And again, that's inflation at a wholesale level, 0.2% forecast versus 1.1% in July. Well, that number came in at 0.2% as forecast. So again, good news, right? But as with the CPI, the core PPI, a little bit different story. It actually also forecast at 0.2%, but it actually came in at 0.3, slightly higher. Now, similar to last month, but because it came in slightly higher, that as a result, kind of another mixed signal. And again, I think that's part of why we saw the 10-year bond yield actually creep up a little bit from when it was, below 3.65 earlier in the week, and now it's getting more closer to 3.70. And the only other economic data point released today was initial jobless claims forecast at 225,000. It actually came in at 230,000, slightly higher, but again, no evidence of layoffs. And that's really it for the economic data points this week. And so as a consequence, I think we should remain at relatively these levels going into the weekend. So we'll see what happens next week when we have a new economic data point calendar and see how that affects bond yields and mortgage rates. So with that, I'm going to bring Jeff back on. I'm going to call him Jeff, the red-nosed reindeer. We're having a little bit of camera issues here, but we want to continue our discussion about the perceived, the expected, and maybe it's here refi boom, because there's some interesting phenomenon, I'll call it, that's going on the refi side of the market. Hi, Jeff.
Hi, Art. How you doing?
All right. How are you?
Good. You know, I've been down in the San Diego Imperial Beach area, and you know they're having some issues with their water or the air, and maybe it's affected my skin tone. I have no idea. I'll have to turn on the black light and see if I'm glowing. But this is quite the unusual look. I apologize.
No worries.
So yeah, it's kind of exciting, this whole thing about the refi and the rates going down and things like that. And I think the thing I really want to talk to you about, it says it's some questions that have come in from our audience. Says it's been suggested there is as soon or soon will be a refi boom, and we've been talking about this for a few weeks. But you're seeing some homeowners' behavior differently in this environment, and really, how so is that? Why is that?
Yeah, it's really kind of interesting because, in my mind, here we are, as we just talked about, we're in the fives. We're in the fives for conforming loans, FHA, VA. And when you consider the last couple of years with all the dismal news about how, home purchases have slowed down and it's difficult to qualify, there were still many transactions that were done, and probably in a lot of cases with what we call situational buyers. Remember that? People who, because of their situation, needed to buy or had to buy even though rates were high and they otherwise wouldn't have done that. So you've got people who a year and a half ago closed purchase loans, in some cases approaching 8%, certainly in the sevens, low sevens. And so as a consequence of that, when you're looking at conforming loans in the fives and FHA, VA in the very low fives, you would think that this perceived refi boom would just be coming at us in a big, big way. And I would argue that's not quite the case. Yes, application activity in refis is certainly up. There's definitely more conversations going on with homeowners about refis, and we are seeing an uptick in actual applications. So that is all true. But what I'm observing this time, unlike previous refi booms or conditions in the past where refinance activity was ticking upwards, what we're seeing more is a case of kind of like what we talked about in the purchase market. I'm having discussions with several homeowners who are basically like trying to time the market on when to do their refi. In other words, when I'm having these discussions, and typically when I do that, I'm providing them actual numbers. I'll send them worksheets after they give me certain parameters, what their loan amount is, what their estimated value is, what their credit score is. And, with that basic information, I can give some pretty specific, tangible numbers to review. And in several cases now, when I'm doing that and having those discussions, I'm able to demonstrate with some of these homeowners that they can save not just $100 a month or $200 a month, but literally like $400, $500, even $600 a month. And yet, when presented with that information, what I'm getting is, the reaction I'm getting is, well, that's great news. But you know what? We're going to hold off because our target goal is we want to save $700 a month or $750 a month. And that's a little bit interesting. And again, a little bit unlike all the refinance boom cycles that I've experienced over the last 4 decades. Normally, when we present a homeowner with something like, again, even $100 a month, $200 a month, $300 a month, they're almost always in this, their response is almost always going to be, heck yes, let's do it. This time's a little different, and I'm a little puzzled by that. I think it has to do with all the media stories about rates are going to start falling. I think we've got a little bit of what I would call groupthink, or another term, the madness of crowds, where everybody driven by all the news media feeds that rates are about to fall. The Fed's going to lower the Fed funds rate. And that, of course, everyone still thinks that means rates on mortgages is going to fall by the same amount. Plus, we got the election coming, and a lot of folks out there still think that the election matters in terms of where interest rates are going to go. And I think as a result of all that, all those headlines, and of course, remember, we always say beware the headlines. I think because of all those headlines, it's putting some folks in this sort of wait and see, let's time the market and let's not pull the trigger on the refi until we save a certain amount of money per month as our goal. And I think I'm a little concerned about that because you know what? None of us have a crystal ball. And I think in a lot of cases, these homeowners, we'd be better off capture those savings while they're there rather than holding off and trying to time the market.
Well, you know what? It kind of makes me feel like a little bit of, I'm going to say, an Instagram type of feeling, or Facebook, where we see only the perfect people and we're gauging ourselves against that. So we're thinking, hey, there's a lot of people out there with 2.75 and I'm not making a move until I get to 2.75 because other than that, I must be a failure. Now, I know you've talked about people who have, $500 a month and they're not happy until they're $700 a month. They're holding off. But what kind of advice would you give a homeowner right now? Because I think, as you said, it's like we're trying to time the market. It's almost like, hey, I'm trying to juggle knives and hopefully I don't get cut with one of those on the way down. So what kind of advice would you give a homeowner right now who is in that situation, who can save $300, $400, $500 a month?
Yeah, very good question. And again, this week's bond market reaction to the CPI and PPI numbers, I think, is a pretty good example. Again, there's this like group think that is developed where everyone is convinced that we're going to see rates fall, and in a lot of cases, they're convinced that they're going to fall by a substantial amount. I would first remind everyone that the most recent forecast by all the major players in the industry, National Association of Realtors, the Mortgage Bankers Association, Fannie Mae, Freddie Mac, et cetera, they're still all, as to their latest forecast, still for 2025 suggesting rates are probably going to be certainly in the 6 range, maybe into the high 5s. None of those observers are forecasting we're going to be in the 4s next year. So, my advice is when you're looking at these kinds of monthly savings, that's money on the table that you can take advantage of right now. And to hold off because you want to eke out that extra $100 or $150 or $200 a month, I would argue that's a pretty risky bet because anything can happen. Something can change without anyone anticipating it that could cause bond yields to suddenly jump up, and these 5 5/8 or 5.125 rates on government loans, 5 5/8 on conforming loans. Well, gee, the next thing you know, we could be looking at, they could jump up by a quarter, 3/8%, and then you've missed an opportunity. And the way I've been thinking about this a lot lately is kind of using when you're buying stock, there's that concept of, dollar cost averaging, and of course, if anyone knows about that strategy, it essentially means you spend a certain amount of money every month to buy stock, to invest in stocks. And the idea is, or maybe in a particular stock. And so you've decided I'm going to invest a certain amount of money on a regular basis to invest in this stock, no matter what, whether the stock's gone up or down, because over time, dollar cost averaging it's all going to even out. In long term, it should be a good investment. So I started thinking to myself, well, maybe a refi transaction ought to be thought about the same way. As we talked about recently, the average closing cost, amount for a refi, a non-recurring closing cost, as we talked about, separating non-recurring from those recurring impound account, advanced funds, and so forth. It's usually going to be somewhere around $3,500, maybe for a much bigger loan amount approaching $4,000. In fact, I just locked in a refi for a loan amount of $550. The non-recurring closing costs are right under $3,000. So that pretty much a refinance transaction for the the median loan amount is going to be in that range every time you do the refi. So in my mind, I think a homeowner ought to consider dollar cost averaging the refi decision, meaning if you have an opportunity right now today to refinance your mortgage, that might be 7 1/4, and you can get 5 5/8 or 5 3/4 if it's cash out, or 5 7/8 if it's cash out, and you can save $400 a month, you ought to do that. Now, if it turns out after you've done that and rates improve further, we go another 0.5% or 0.75% in the next 6, 12, 18 months, well, then obviously the obvious thing to do is then pursue another refi, because your cost basis is going to be about the same. And then by doing that, you might then eke out another 100 or 200 bucks a month. The point of it is, I think that's a better strategy to optimize your savings over an extended period of time over, if I show you can save 400 bucks a month now, but you're trying to get 600, well, consider this. You don't know when rates may fall enough to get that 600, if they do anytime soon at all. And in the meantime, you're giving up that $400 a month savings every month until you get to your goal, if you get it. Why not take that $400 now, and then you're saving that amount each month as you wait for that extra 0.5% or 0.75% or 1% further improvement, and then refi again. That way, again, you're optimizing your total savings over an extended period of time, if we're going to have an extended downward trend interest rate environment. So that would be my advice as a better way to think about it. Ignore all the news. Look at the dollars you can save right there on paper on those worksheets I give you. Grab those savings, and then let's see what happens. If rates get a lot better, we'll do it again. And in the meantime, you're saving $400, $500, $600 a month. I don't know why you wouldn't do that. I just think it makes a lot more sense. I think it's a better approach.
Well, Art, it reminds me of a show I used to watch. It's Deal or No Deal, and somebody would have some money that they have, and it's a matter of, will you risk it for the unknown? And it sounds like you're saying, it reminds me of that saying is of like, 2 in the hand is worth more than 3 in the bush, because I don't know for sure if there's actually, I can get those 3. I like what you're saying is, hey, don't roll the dice. Go ahead and take advantage of the rates as they are now, because are there any guaranteed signals out there that said, hey, the rates will not go up?
Not really. I mean, and as we talk about every week in this program, and how, economic data points are released every week, and the market reacts to those every week, and sometimes in different ways. And sometimes some of those data points are conflicting signals, and it can really kind of confuse the analysis of where are we really going. That's why we always put on that slide on financial markets. They respond with reptilian-like minds to stimuli. So it can be all over the map. And what I've seen over the years, over the decades, is you can suddenly have a change in the economy and the financial markets, even internationally, where suddenly things, when everybody thought it was going one way, suddenly things reverse and go the other way. I mean, I can remember the spring of 1987, when we were enjoying what we thought were great rates in the 8s. By November, we were in the 11s.
Oh, geez.
Now, there were certain things that happened during that period that caused that to occur. Do I see that happening right now? No, but, there's always a yeah, but. Well, the yeah, but is, again, all the signals. Well, I wouldn't say all the signals. I think some of the signals are still mixed, but, many of the signals, and then further propagated by the media, who likes to be a cheerleader in this environment, suggest that things are going to continue to get better. But I would just caution everyone, be careful with falling into that groupthink and just assuming and getting lazy about, oh yeah, we're going to be fine. Yeah, we've already waited, and we're, because I can think of one homeowner, when I first started, I was telling him it was about 430 bucks a month that they could save. Well, then I told him, hey, now we're at $525 you can save. And then just a few days ago, I said, here we are now, you can save 635. But they're waiting for 700. Now their approach has been, I guess, supported by the idea that they're seeing that by waiting, the monthly savings I'm presenting them has gotten better. But there's going to be a stop to that, and it could be sooner than later. And if the stop turns out to be not just a stop, but a bounce the other way upwards, they're going to be a little disappointed. They could end up going back to where they're only going to save 500 when it could have been 600, or they're only going to save 400 instead of 600. I just don't think, when you're getting to those kind of numbers to save per month, why in the heck would you not take advantage of it, run with it? And then again, if I'm wrong, if things really do continue falling at an extended pace for an extended period of time, come back. Well, we'll let you know, and then we can look at refinancing again.
Well, I love that idea. Let's go ahead and lock in. I do want to get a little bit of information, because you said something earlier off camera. It was talking about MortgageWorks is participating in a broker in a broker program being touted as Refi 75. How will this benefit a homeowner looking to refinance their loan, Art?
Yes, I did want to talk about that. For everyone who's listening, both real estate agents as well as homeowners and prospective home buyers, et cetera. But this is particularly for refinancing. And again, agents, I think you should hear this either for yourself personally or for clients of yours where you sold them a home maybe in the last year or two, where they got rates that might be in the high sixes, in the sevens, or maybe even approaching 8%. We are signed up with many lenders, in fact, over 16. One of the lenders we are signed up with is a wholesale lender. They don't offer mortgages to the general public on a retail basis. They only serve the mortgage broker community. Some of you may have heard of them. They're called UWM, or United Wholesale Mortgage. They tout themselves as the largest wholesale lender in the country. They're a publicly traded company. You can look them up and see what their stock price is and look at their financials. They recently, just last week, announced an initiative that they're calling Refi 75. And it's really a pretty tremendous opportunity for homeowners. What they're offering is, when I price out a loan with them, they are offering basically 0.75% improvement on the pricing. Well, what does that mean? Well, 0.75%, think of it as points. Like, think of it as 3/4 of a point. 0.75 means 0.75% of your loan amount. So when we price out a refinance scenario, when we get the result, we're going to get 0.75 lower in the price for the loan than they otherwise would be offering. That can be a significant benefit in terms of rate. It's going to be generally probably at least 1/8%, more likely 1/4 in rate over what you would otherwise get. Now, these are specific only to certain types of loans. Conforming 30-year fixed or conforming fixed rate loans, that's Fannie Mae, Freddie Mac eligible loans, sold to those two quasi-governmental agencies, again, conventional loans, as well as FHA and VA, and only for what we call rate and term. You don't get this benefit if you're getting a refinance to pull cash out. So it's only for refinancing where you're looking to lower your rate. And then the other interesting thing about the program is that UWM, United Wholesale Mortgage, is only making this available to brokers who adjust their lender paid compensation to 1.5% of the loan amount or lower. Now, you may recall in recent weeks on our program, I explained lender paid compensation and how we at MortgageWorks have one of the lowest lender paid compensation levels of any brokers out there that we compete with. With most of our lenders, we are at 1% of the loan amount. Many of the lenders I compete with, in fact, I just experienced a situation recently, are in terms of competing to get a refi from a homeowner. Many brokers are at 2 or 2.25 or 2.5. Those brokers who want to optimize how much they make per loan, they're not eligible for this initiative, because UWM says, look, if you want 2.5% on the loan, more power to you. But if we're going to give up 0.75 to help you get more refis, we're not going to make it available to you because we think you're asking for too much money when you deliver the loan to us. So if you want to participate in this 0.75, this Refi 75 initiative, you need to lower your lender paid compensation that we're going to pay you for delivering that loan. You need to lower it to 1.5 or less. Well, in our case, we're already well below that. We're set up with them at 1%. So guess what? Right when they kicked this initiative off, we were right there first in line to be eligible for this initiative because of the fact that our lender paid comp is lower than most any broker that we compete with. So what I want you all to know, again, if you're a homeowner and you've got a loan that's in the high sixes, or frankly, even the mid sixes, approaching 7%, 7.25, 7.5, or approaching 8, or if you're an FHA, VA borrower, and again, you've got current rate when you bought a home a year or two ago that's in those same levels, in mid sixes up close to 8%. We're involved in this initiative. We have one of the lowest lender paid comp plans with UWM of any of their brokers. You need to call us so we can show you what the numbers are. And agents, again, if you have any past clients that you close a loan for, a purchase loan, where you know that they got rates in the 6.5, 6.75, 7, 7.5, et cetera, you should contact those clients. Let them know that we have this initiative, this offer that we can share with them, we can present to them to see if it's going to make sense for their situation. So if you're looking to refinance to lower your rate, again, no cash out, but to lower your rate with no cash out, this is going to give you probably the best rate you're going to see on the market right now for a refi. So I would say don't hesitate. Give us a call. Give me a call. I'll be happy to give you some numbers.
You know, Art, today the SpaceX team was up there and they were the highest altitude ever for spacewalk. And they went out there spacewalking and they saw things that a lot of people can't see. I feel like I'm talking to Elon Musk, who can see things that other people can't see. You got to call Art at 969-5023 and he'll get you set up. If I understand this correct, so let's just break it down for a kid from West Texas. If I were able to get 5.5, or let's say 6, let's keep it easy, 6, and I qualified for a loan through this particular initiative, does that mean my rate is 3/4 of a point lower?
No, not quite.
Okay,
yeah,
all right.
That's an important question, and let me clarify that. The 0.75 is not in rate, and this gets a little technical. The 0.75 is what they call a price adjustment factor. So think of it as points. So if you've got a 6% rate available to you at 0 points, if you're able to be eligible for this initiative, when we price out the loan, your UWM is going to give us, MortgageWorks, a price for that loan that's going to be 0.75% of the loan amount lower in price. What that's going to translate to the borrower is, instead of 6%, they're most likely going to get a rate like 5 3/4. So I would say a good rule of thumb is, in looking at this initiative, if you're talking to lenders already about a refi and you're quoting something like, again, we're using 6% as an example, with this initiative, you come to us with the same loan parameters that you're talking to this other lender for at 6%. Come to us, we're probably going to be able to offer you 0.25% less, 5.75, because of this 0.75 reduction in the price for that rate.
And when we're talking about a loan on a mortgage, and it's 0.25% less, I mean, that can make a significant difference on someone's monthly payment, can't it?
Well, absolutely, especially again when you get into those higher loan amounts, 4 or 5, 600,000, and again, I mean, 0.25% is a big deal. I mean, I've seen people shop around and try to eke out an extra 0.1% when they're shopping for a mortgage. Wow. If you can get a 0.25% better deal simply because of this initiative over anybody else you're talking to, this is kind of a no-brainer. I mean, I can't imagine why you wouldn't take advantage of it. And this is only going to be around, by the way, through the end of next month. It's not on forever. This is a initiative that's in place for a specific period of time. It is taking advantage of the fact that rates have dropped. We're in the 5s. And so, for example, we just talked about FHA VA rates. We're at 5.125. With this initiative, if you're going to do a refinance of your FHA loan and get 0.75 off the price of the loan, I could very easily take that rate of 5.125 and could take it to 4.875, 0.25% less. That could get you under 5%. I mean, are you kidding me? I mean, why wouldn't you do that? So
what are we waiting for?
Different. You would need to contact me, and I'd be happy to give you the numbers that reflect this initiative.
Well, Art, thank you. This is exciting news. And on the screen, it shows how you can get a hold of Art today at 760-969-5023. And Art, thank you so much for really walking us through this whole refi boom and how real is it. And I think initiatives like you're talking about that you're qualified for to offer, it's only going to make it even more important for people to contact you. Again, 760-969-5023. Art, I'll turn it back over to you.
Okay, thanks, Jeff. Okay, everyone, as you know, we now go on to cover our closing question from last week. So Jeff's going to go ahead and pull that up now. And it was an interesting question, and it was one we did get last week from a viewer who's in the market looking to buy a home, and it has to do with credit scores. And here it is. Currently, our credit scores are 680 and 690. Not bad, right? I would call that maybe a sort of a B minus in terms of credit score level. If we were to improve our interest rate for a new loan, how much would they need to improve to see a better rate, and how much of a payment difference would it make? Or should we lock in a rate now and then begin credit improvement and come back to refi? Well, of course, as with so many things, it depends. The answer on this question depends. It depends on what type of loan you're getting. And in this respect, I'm going to discuss the question in relation to the two most common program types. Conforming conventional, again, those are loans sold to Fannie Mae, Freddie Mac, and FHA. Now, with a conforming conventional loan, a credit score in the 680 to 690 range, believe it or not, is in the only the sixth best, what I call pricing tier. Because with Fannie Mae, Freddie Mac loans, your loan is priced, and therefore the rate you're going to get is going to be determined on 20-point increments. In other words, the highest rate you can get, or I'm sorry, the highest credit score necessary to get the best rate for a conforming conventional loan is 780 or higher. That's the top pricing tier. Then we go 20 points lower for each tier. So 780 is the best, 760 is second best, 740 is third best, 720 fourth best, and so on. So if you're down 680 to 699, you're in the sixth best pricing tier. Now, what that can mean in terms of rate, 680 to 699 versus 780, it can be on an average loan amount. I'm using 500,000 here. It can be 0.5% in rate difference. That's not insignificant. That's $181 a month if you're getting a $500,000 loan at 10% down. So how does FHA handle that? Entirely different. I've always said FHA loans are much kinder to the borrower when it comes to credit score. Believe it or not, on an FHA loan, the highest pricing tier, the best pricing tier, is usually 740 or higher with most lenders. So the second best pricing tier, first of all, is much wider than 20 points. 680 to 739 with most lenders is going to get you the second best pricing for an FHA loan. And as a result, even if you're in that second best pricing tier versus that 740 or higher top tier for an FHA loan, the difference in your mortgage terms are going to be more about the price. Again, think in terms of points versus the rate. I priced one out yesterday, and whether you're at 680 or 750, I would be able to still get you a 5.125% rate on a purchase. What would the difference be between being at 740 and 690? It would be about 1/8 of a point in fee, which in the case of the higher credit score, you would actually get a net lender credit of about 1/4 point from the lender after we're paid. And so if you're at 690, instead you'd still get the same rate, but you get about 1/8% of your loan amount as a net lender credit after we're paid. So the bottom line here is FHA is much kinder to credit scores than conventional conforming. And I would argue that if you're anywhere from under 780, certainly if you're down in the 680 to 699 range, or even lower than that, and if in particular if you're putting less than 20% down, in virtually every case, you're better off going FHA. FHA has sort of this reputation that the mortgage insurance cost is too high. Not so true anymore. Remember, it was last year, FHA, actually almost 2 years, lowered the annual mortgage insurance premium. It's much more competitive now with conventional conforming loans. So I would argue that if you're putting less than 20% down, frankly, even if you're at the 780 credit score level or higher, you're going to be better off. You're going to get a better rate and probably a better monthly payment if you go FHA. And so as a result of that, in terms of answering this person's question, with 680, 690 score, and especially if you're putting less than 20% down, you should go buy a house now. I will show you the conforming conventional. I'll show you the FHA. You're probably going to see FHA is a better deal. You're going to get a better rate. Again, you're going to be in the low fives. And even with mortgage insurance factored in, you're still going to be probably mid fives, maybe 5.6, 5.7 all in. That's going to be a better deal. Get that home now. Take advantage of home ownership. You'll start to see some appreciation in that home. And then if rates do fall further, and if you get your scores up further, then we could look at refinancing, and then at that point compare, is FHA the right choice for the refi, or should you go with conforming conventional? So I hope that clarifies credit scores, how they affect your mortgage rate on both conventional and FHA loans. Great question. So if you have any, if you're in this situation, you're considering buying a home, give me a call. I'd be happy to discuss this with you further and give you some hard numbers to look at. And so with that, we're going to go ahead and go to our closing question for next week. Here it is. And it's an interesting one. And I just had a home buyer ask me about this about 2 weeks ago. We've been told that if putting less than 20% down on a home purchase, we would need to set up an impound account for taxes and insurance with our purchase loan. But we're planning on putting 15% down. Why can't we pay taxes and insurance on our own? Excellent question. So we'll cover that next week on our Mortgage Minute program. So in the meantime, I want to thank you all for watching and listening. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. Again, rates are very low. If you're on the fence about buying, get off that fence, start looking at homes. If you're looking to refi, don't time the market. Call us. We'll talk to you about our Refi 75 initiative through UWM. Let me show you some numbers so you can take advantage of the monthly savings today. So long. Take care.